Hello and welcome to the first in what is hopefully a series of at least one and possibly several webinars for Tax Insider. This one being Landlords in Lockdown, Building Back Better, Tax and Developing Your Own Property. Just in case you don't know what day it is, Thursday 25th of February 2021. Now, in what should be a surprise to absolutely no one, this will be a tax-centric talk aimed at landlords and their professional advisors, hopefully highlighting tax issues arising when developing a landlord's existing property portfolio. So we're not aimed at property developers, we're focusing on UK resident landlords and landladies with predominantly long-term residential lettings, but maybe incorporating a few commercial properties, typically flats over shops type scenario, because we'll be talking a little bit about the high street and implications for property on there. So we're looking at trends in the UK property market, whether transactions will be taxable or subject to capital gains tax or income tax and why it matters, hidden tax triggers, and in particular the new CGT rules that came in April 2020, VAT and the construction industry scheme or CIS, and possibly the use of companies. Now, I've started the presentation by playing to one of my strengths as a tax specialist, which is forecasting property market trends. So with that in mind, residential property, it seems quite likely that the demand will stay firm, but the composition of demand may well change. We may well see a decline in demand for urban living, but as I say, there seems to be quite strong demand for residential property overall. Savills, for instance, is predicting over the next 5 years for capital value in property, residential property overall, to rise anywhere between 17 and 25% depending on the region. In terms of commercial property, I think it's a bit patchier, and we may well see a significant fall in demand for office space, and it does look like we are seeing a continuing decline in high street retail. Now, digging a little deeper into residential property market trends, the short term, no question, it's been pretty drastic. For example, private bedsit type rents in London, the going rate has fallen by more than a third in some areas, and more widely, rents in British cities, the asking price has fallen by up to 15% in the sort of current pandemic. But if we look to longer term trends, what does seem clear is that the attraction of working from home has gained a pace, and we're likely to see a much more blended approach to work in the future, far less of a clear line where people are commuting 5 days to work in an office, etc., etc. So that seems to me to suggest that there may well be less demand for city living, but with the rider that city living is not just about being able to walk to work. There are still strong cultural and social drivers towards living in a city, so that they will remain, I think. The pressure on demand for commutable locations seems likely to fall, with remote locations becoming more popular. Demand for roomier properties will go hand in hand with that, I think. And there may well be less demand for cars and drives and garages as a result of there being less pressure on commuting. And of course, broadband connectivity and being able to zoom into the office will have a part to play as well. Looking briefly at commercial properties, it's obvious that if there is more demand for working from home, it seems likely that demand for office space will fall. And I think we should also consider the fact that UK high street footfall has declined by 10% in the 7 years to 2009, and by almost half when comparing December 2020 to December 2019. And I think that it's reasonably fair to say that while the worst of the pandemic is going to be relatively brief, I do think that we will see that the pandemic has hastened some of these trends in terms of commercial property, high street and office space, etc. So digging myself even further into a hole when it comes to property forecasting, what does this actually mean? Well, maybe converting residential properties into larger properties with fewer dwellings per plot, but maybe cheaper plots in more remote areas, provided you've got that all-important internet access. And maybe today's twin garage is tomorrow's home office. We may see conversion of commercial properties into residential dwellings, hopefully where they're suitable, and retasking of commercial property from one use to another, or even blended use. So hopefully on to slightly safer ground for me. Tax aspects to property conversions. If we are going to be reworking our existing portfolio to accommodate changes in demand, with bearing in mind some of the changes that I've suggested may happen, we're now going to look at what the tax implications are, capital gains tax or income tax, and why it matters. I want to warn you about some of the hidden tax triggers, in particular the new CGT rules and when they might come about, VAT and CIS or Construction Industry Scheme, and potentially the use of companies as well. Now, capital gains tax or income tax and why it matters. Well, it matters because income tax is a lot more expensive than capital gains tax. So if a broadly similar transaction is going to end up being taxed at the maximum capital gains tax rate, which is currently 28%, that's a heck of a lot better than income tax being charged at 45%, potentially with national insurance contributions for on a self-employed basis of at least 2%. The difference is quite significant. Now, Amir tells me I have to include worked examples in my presentations because just telling you that taxing a construction project as a trading activity will cost you roughly double in tax what it costs you if it's taxed as a capital gain isn't good enough. So with that in mind, let's take the example of Jane. Jane's large investment property cost £400,000, doesn't matter when she bought it. She intends to convert the property into two separate dwellings at a further cost of £300,000. And when she's finished, the two new dwellings will then be worth £500k each, roughly £1 million in total. So depending on how it's taxed, that net capital gain or profit on sale will be £300,000. And for simplicity, we're going to assume that Jane is a high rate taxpayer, 60k's worth of other income. On that basis, if it's all taxed as trading profit when she comes to sell those two dwellings, the tax and national insurance cost is going to be around £145,000. Whereas if it's taxed only as a residential gain, even at the 28% rate, the extra CGT bill is going to be £81,000. So that's a difference of well over 60k. Now, some of you may well be able to afford to lose more than 20% of your net profit to additional taxation, but some of you may have mortgages to pay, or you might need as much as possible to reinvest into your next project. Not to lay it on thick with the examples, but there's another example called Joan later on. It's quite an ambitious question, this. Capital gains tax or income tax? Can you choose for a given set of facts? Simplistically, the answer is of course no, but it's also fair to say that over the years very many tax cases have tussled with whether or not a given transaction or scenario, construction project is capital in nature or is trading. Property in particular is problematic because it can readily lend itself to either scenario. You could, for example, have a construction project which is clearly trading that can take several years to come to fruition, or you could buy an investment property, let it out for a couple of years and then sell it on and probably expect that to be subject to capital gains tax on disposal. And of course you can have any number of possible variations in between those two so-called extremes. Now what these very many tax cases have told us essentially is that it will boil down to the facts of each particular case, but with particular consideration given to the taxpayer's intentions. It's important, but it's not the full picture. There are other aspects to consider, notably the badges of trade, but the other complicating factor is that if you hold a property for long enough, your intentions will probably change. Now, enhancing a capital asset is still within the scope of capital gains tax. And if you build to enhance and hold the property indefinitely, then it's likely to remain within the scope of capital gains tax. However, HMRC would much prefer that you paid income tax, and in that regard HMRC will try and argue that if you're developing land or property for a profit on sale, they have this idea of a supervening trade swooping down and magically transforming your capital asset into an asset in the course of construction, subject to income tax and ICs when eventually sold. And because they weren't always successful in this argument, HMRC decided to supercharge the transactions in land regime in 2016, so that the statute now says that if you develop land or property for a profit or gain on sale, then it was subject to income tax. So simplistically, as a landlord, if you are developing an investment property with the intention of selling it on, then your project is likely subject to income tax and maybe to NICs. If you are building to enhance and hold, then likely capital gains tax. But if you've ever held a trowel in your hand before, in this or a previous life according to HMRC, then they will have a stab at arguing there's a supervening trade and the profit or gain on disposal will be subject to income tax, etc., etc. So again, to summarise, if you acquire a property and you hold it as an investment and you develop it and you continue to hold it, your intention is to hold it, to continue to hold it as an investment property, then its disposal may well still fall within the scope of CGT. But developing to sell will almost certainly be subject to income tax. And one last point is that if there is a choice in the legislation as to how a transaction should be treated, the tax treatment of disposal, etc., if it's CGT versus income tax, then income tax will win according to the legislation. Here's another question. CGT or income tax, can it be both? Well, again, yes it can, although it's important to emphasise not at the same time. By which I mean, you could have one project on a property that you've held for a number of years. You get to the end of, you've had a rental property for say 5 or 6 years, and you want to do it up and sell it on, and you're hoping to make a gain, so you fall within the transactions in land regime, assuming that there's no supervening trade. You might only see one taxable project at that point. But under the transactions in land regime, it could be broken down into two separate phases. Capital gains tax on any gain made from the point of purchase up to the point of starting the conversion, which I would call the investment phase, and then income tax on the bit that's caught in the transactions in land regime, which is the development phase to the point of sale. So it's not taxing the same uplift twice, but breaking it into two separate stages, one subject to capital gains tax, one subject to income tax. And if you think about it, that's a good thing, because at least any gain up until the point that you have the mad, crazy, foolhardy idea to develop the property for onward sale, the gain up until that point will stay within the capital gains tax regime and be taxed at generally a lower rate. However, there is a potential very nasty sting in the tail that is important that you're aware of, very important that you're aware of, and that is thanks to a rule change that came in April 2020. And this kind of leads me on to the next stage of the webinar, which is to look at the tax traps specifically for landlords who are looking at developing property, and that is capital gains tax when it's due and even if there's no sale, and then VAT considerations, and then construction industry scheme. Moving on to the first of those tax traps, new capital gains tax regime was introduced with effect from 6th of April 2020, so that's last year, whereby any disposal which gives rise to a capital gains tax charge in respect of UK residential property has to be notified to HMRC within 30 days of that disposal, and you also have to make a payment on account of the CGT that is calculated to be due. It's important to note that this is in addition to any ongoing responsibility to file and pay under self-assessment. So if you're a landlord or landlady who has been making annual self-assessment tax returns for any number of years, this will be an extra requirement. It will mean additional paperwork, having to notify and to calculate much earlier than in the past, and also having to pay the CGT much earlier than would traditionally have been the case. Now, for people who are tax resident in the UK, the requirement to report applies only where CGT is actually due on the disposal. So things like the disposals of one's only or main residence will generally not be reportable. However, it's important also to bear in mind that landlords, landladies have a nasty habit of letting their property that has at some stage been their only or main home, and relying on lettings relief as a subset of the overall only or main residence relief to cover the CGT that would otherwise arise. And there was a change to the lettings relief with effect from 6th of April 2020 again, which means that if you've accumulated lettings relief or accrued lettings relief prior to 6th of April 2020, you are extremely unlikely to be able to rely on it on or after that date. So not only are you going to have a capital gains tax bill when you thought there wasn't one, or a larger bill than you anticipated because you're unlikely to benefit from lettings relief anymore, it may also trigger a duty to file this new 30-day return and to pay that CGT on account much earlier than you would have expected. In other words, walk you into a penalty situation. But if you think that's bad, please spare a thought for people who have not been resident in the UK and have made similar disposals of residential property in the UK For several years they've had to put up with this regime, and it applies to them even if there is no CGT that's due. So you're literally just having to file paperwork with HMRC. The cynic in you might well surmise that this is purely an opportunity for HMRC to generate penalty after penalty after penalty. And even worse for non-residents, it also applies to non-residential property disposals in the UK as well. As an aside, I wanted to highlight another issue which is going to catch some taxpayers off guard, which is that many taxpayers assume that if you make a disposal of property by way of a gift, then no CGT is due. The logic presumably being that if there is no money, then there can't be a tax bill. And I'm afraid that in many cases you'd be wrong in that assumption. HMRC doesn't see why it should have to give up its slice of capital gains tax just because you've been kind enough to give your property away or sell it at a, intentionally at a discounted amount. This again might raise queries with taxpayers who are perhaps used to transfers of property between spouses or civil partners who are living together as a couple. And you're quite right, spouses and civil partners can transfer property between themselves without triggering this CGT on gifts, but it is only because they are spouses or civil partners, not because it is a gift. And gifts to relatives, sales at discounted amounts to third parties, for example, will still trigger capital gains tax on the notional full market value of the asset. Now, going back to a couple of slides ago when I warned that you might have capital gains tax and income tax to pay on property development over its entire life cycle, and I raised the point about when that CGT on phase one might fall due. This kind of a scenario here, you might find that your capital gains tax is due within 30 days of making that transition from an investment property to an asset for development in the course of the trade. In those circumstances, you can elect to roll the capital gain into the profit on eventual sale. In other words, don't pay CGT now, pay taxable profits, income tax on those profits when the property is ultimately sold to a third party. But that's unlikely to be a good idea for individuals. The main point being that capital gains tax is at most 28%, whereas income tax is 45%. And to illustrate the point, let's take Joan, who has a large investment property that cost £400,000 in 2000, let's say. Today it's worth £600,000. She intends to convert the property into two separate dwellings for immediate sale at a further cost of £300,000 to sell at £500,000 each. Just to emphasise the point that it is already standing at a £200,000 gain before she does any work on the property. It was worth 400 when acquired. It's worth 600 now. She's going to spend another £300,000 on it to increase the sale value by £400,000. Of course, these figures are the same as in the earlier example of Jane, except we now also have a current pre-development valuation at £600,000 figure. Now, if we assume that Joan's development project is going to be treated as a trading activity, then she'll be deemed to dispose of that long-term 20-year-old investment asset to her development activity, even though there has not actually been a sale and there are no proceeds. Capital gains tax will be due within 30 days of that transition to an asset in the course of construction, and that will be £64,000 if we assume that Joan, like Jane before her, is a higher rate taxpayer already. There will also ultimately be further income tax and NICs of roughly £50,000 on the profit, the development profit of £100,000, which is basically the extra £400,000 added to the value of the properties after spending an extra 300k to convert the large single property into two separate dwellings. So that's 64,000 of capital gains tax, and that was paid very promptly at the beginning of the development process, plus the 50,000 that we're now talking about at the end of the sale of the two dwellings, comes to 114,000. Or Joan can elect to roll that initial capital gain on transition to a development project into the taxable profits that are deemed to arise when the properties are ultimately sold. But we know from the example at Jane B that her tax bill will then rise from 114,000 to 145,000. And this just reflects the fact that you're effectively swapping a capital gain tax bill at 28% for trading profits that are taxable at 40% plus. Some assumptions have had to have been made about the figures just to make them work simply, and they might well be a little bit different in real world cases, but the basic comparison still holds. So in summary, the election to postpone your capital gains tax charge might seem generous because it's going to give you more time to pay, but it's really legalised loan sharking, because the increased tax charge in most cases is just going to make your nose bleed. Having said that, if you're operating this within a company, within a corporate wrapper, then you would simply be trading 19% corporation tax on capital gains for 19% corporation tax on trading profits. So you probably would make this election if you were talking about a rental business in a company that then decided to develop one of its properties for as a trading activity, say. And just to develop this idea a little bit more is the warning that consider the potential implications of converting a property that you originally intended to use in your residential property business, and then decide halfway through that you want to sell the property once complete. You may have moved from a capital investor footing to a trading developer type footing, and that may trigger, practically speaking, immediate tax consequences and an immediate capital gains tax charge, or a 30-day tax charge. Now, although it's unlikely to happen to a landlord who is primarily an investor, it also works in a similar way for property developers who decide that, trading property developer decides he or she wants to keep a property that they initially intended to sell. They actually get charged to income tax and NICs on the value of the property at the point they decide to appropriate that property for a fixed asset purpose, for a capital purpose. They're deemed to make a sale to themselves, and again they'll have no proceeds to fund that tax bill. It might seem strange to raise the topic of VAT when talking about residential property landlords, because of course, as you know, most residential lettings are exempt for VAT purposes. Here I want to focus on property conversion costs and your building costs that you'll incur when undertaking a property conversion. And in the right kind of scenario, your builder will be able to charge you either significantly less, or in some cases even no VAT at all, for the bulk of your construction services. Good examples might be converting formerly commercial office space for residential use, or changing the number of dwellings up or down in a building's envelope. And you might recall that when I was doing my Mystic Meg impersonation in the opening slides of the webinar, I suggested tentatively that we could see more of these types of developments going forward. So, for example, former office space having fallen into disuse being converted, where appropriate, into residential dwellings. Or, in some cases, taking a large property which maybe has been converted into 5 apartments, let's say converting that into 4 roomier, more spacious apartments that are more suitable to people who want to work from home 3 or 4 days a week. Now, for those of you who are saying to yourselves, well, I don't worry about VAT because my builder isn't VAT registered anyway, so there is no VAT, I would disagree with that. I would point out that your non-VAT registered builder will be paying VAT on all of their materials, etc., etc., and will not be able to recover that VAT. So in actual fact, a VAT registered builder who is able to recover all or most of the VAT on their materials costs, etc., but then charge you only 0 or 5% VAT when they actually provide you with the service, you can quite easily end up with a smaller bill overall. But no talk about VAT would be complete without a warning about some of the implications and the traps. And in particular, I want to make you aware that there could be very serious VAT implications of moving from commercial to residential lettings, because many commercial lettings will be subject to VAT. You will have opted to tax your commercial lettings, and you will potentially move to not being able to charge VAT if you move to a residential letting basis. And the reason why that's bad, or potentially bad, is because you will suddenly find that you can't reclaim any or all of your VAT on your costs in relation to making an exempt supply, and you may have to deregister for VAT entirely if you no longer make any taxable supplies from a VAT perspective. Another area where investment businesses, property landlords, may think this won't apply to me is the construction industry scheme, or CIS. Any of you who've been involved with substantive property development projects should hopefully be familiar with the idea of CIS. It's like running a basic payroll system for the people that you contract to do your construction work, such as plumbers, electricians, plasterers, project managers, that kind of thing. And very simply, you have to check each of these subcontractors' status with HMRC, and they will tell you whether or not you can pay them their invoice, or whether or not you have to withhold 20% of the value of the labour on that invoice, and then pay that over to HMRC directly on behalf of your plumber, plasterer, electrician, subcontractor. Now, this is not only a major faff, but the penalties for not applying CIS are substantial. and in the worst case, you can even end up being directly liable for the tax that you should have withheld on your subcontractor on your payments to those subcontractors, and that can be a very substantial sum indeed, on top of any penalties for actually, not filing CIS returns, etc. Now, a trading property developer, somebody who goes out and acquires property to develop and then sell on straight away, will almost always be caught for CIS. And they should be very familiar with the regime. But HMRC also says that property investors, landlords, landladies, taking on major projects, conversions and the like, will, for the period of that project, also be caught for CIS and will need to make the appropriate changes to their accounting systems and reporting systems. I have to say that the legislation supports HMRC's position that it could theoretically include property investors undertaking a significant construction project, such as, converting offices into residential dwellings, something meaty that lasts for several months. But the law is illogical and pretty poorly drafted in this regard. One final point to make is that if you are a property investor paying several £100,000 to a host of plumbers, plasterers, bricklayers, etc., and you find out afterwards that HMRC wanted 20% of the labour element of those payments to be withheld, and because it hasn't been, they are taking it from you because you didn't apply CIS correctly, then if you're a property investor, you haven't sold the property. So all of this tax that you should have withheld and are now liable to HMRC for directly is going to have to come out of your future rental income. Looking very briefly at companies to undertake a property development project, at first glance, companies can look pretty attractive because they pay just 19% corporation tax on rental income, development profits and capital gains, whereas as an individual you might be paying 40-45% income tax or even 28% CGT. But it's important to bear in mind that that 19% is just the first part of the story, because you will also almost certainly have to incur a further tax charge personally to get those corporate funds into your own bank account. So the company has to pay you a dividend or salary, which incurs further NICs, national insurance contributions, or even if you decide to wind up the company at the end of the project and extract the funds by way of a capital distribution, there is more protection afforded in terms of limited liability if you run a project through a company. That can be very useful if your development project is subject to risk. On the other hand, there's more administrative work, there are more duties of directors and shareholders to consider, more formality. Even then, it's worth bearing in mind that loan finance on developing to rent is still caught by the residential lettings interest restriction for income tax, which restricts your income tax relief to just 20%, which is the basic rate. So again, if you're developing a residential property to let it out, any costs for developing will still be subject to the residential lettings restriction, but not companies. Companies don't suffer that in almost any circumstances at all. To summarise, I would say that unless the interest costs are substantial, companies tend not to be significantly cheaper or meaningfully cheaper unless you can afford to take the company's profits out over time. and by that I mean several tax years, so that you can perhaps use the company like a money box company, a pension type situation. Or if you have long-term plans to share the wealth that's accumulated in the company with, say, other members of your family, the next generation, that kind of thing. Now, I've deliberately avoided talking about entrepreneurs relief, or what we now call business asset disposal relief, in its latest incarnation, partly because it might overcomplicate things, but it's also worth bearing in mind that you cannot now qualify for entrepreneurs relief when you wind up a company until you've held those shares for at least 2 years. And I'm looking at companies in the context of a property development project that might last for a few months, rather than a property development trade that might be ongoing for a year or 2 years or more. So what have we learned? Well, we've learned so much that it's filled 2 slides. Developing or converting a property can have unexpected and swift tax consequences, even in the middle of construction, and even when you're not contemplating an onward sale to somebody else, even if you're going to keep the property for your own purposes. Gifts and disposals to oneself, by which I mean appropriating a property from one form to another, say a long-term capital asset to an asset in the course of construction for trading purposes, those can trigger CGT, and they can trigger CGT very quickly. Bear in mind that CGT on UK residential property disposals is now reportable and payable much sooner, sort of 30-day turnaround there, which is going to catch a lot of people out, particularly those who are not aware that there is CGT to pay on gifts in most scenarios. Some developments can trigger income tax, potentially even national insurance contributions, instead of capital gains tax, even on investment properties that were initially acquired for investment purposes. Some developments can trigger both, albeit at different stages. And in particular, changing your mind or your intentions regarding a property project partway through can trigger CGT or even income tax on a sale to yourself, potentially very expensive, with no actual money, no proceeds to show for it. Moving on, serious construction projects undertaken by landlords, landladies, can trigger a requirement to follow the Construction Industry Scheme regime, CIS. But I want to emphasise that I'm not talking here about the odd bit of redecorating properties, replastering walls, rewiring, that kind of thing. I'm talking about a construction project that is going to mean a radical overhaul of a property and is going to take weeks or months to complete. That's when CIS might apply to property investors. As regards VAT, be careful if you're changing a property from commercial use to residential or vice versa, because that can have long-term consequences. But do bear in mind that VAT can be your friend. It can be useful. Depending on the nature of the property conversion that you're undertaking, you can ask for your contractors, your subcontractors, to charge lower rates of VAT or no VAT at all, which could be very useful. Companies, we all know that companies can save you significant amounts of income tax if you've got substantial residential property mortgage interest to pay. But looking at it from a sort of construction project perspective, they are potentially expensive if you need to extract all the profits quickly. but they can still have their uses if you are looking to use them, spread the accumulated wealth extraction over a number of years, like a money box or pension type scenario, or if you're looking to share the wealth that's accumulated amongst family, next generation, that kind of thing. But apart from the new rules about disposing of residential property in the 30-day time frame for notifying and paying HMRC, and the thing about gifts potentially being subject to CGT, if you ever feel the urge to pick up a trowel, please make sure that you have had proper tax advice before doing so. Thanks very much.